Hello, and thank you for joining us tonight on this special webinar we got planned for you guys tonight on banking on your syndication, and just to help you guys change the way you think about your finances and teach you a new financial strategy, which we call the infinite banking concept. So anyway, thanks for joining us, and we hope you guys really enjoy this webinar and really learn from it. As always, reach out with questions. If you have questions during the webinar, put it in the chat at the bottom of your screen. Feel free to, we'll put our contact information later on. You can reach out to us, and we'll get you answered. Let's dive in. I'm going to give you a food for thought for a minute. So I call these my ponderments. I love this quote I heard one time, and it goes, people change in 4 different seasons. And they change if they hurt enough that they have to. And they change when they see enough that they're inspired to. Or they change when they learn enough that they want to. Or they change when they receive enough that they're able to. I just want you to think about that as we teach you new things tonight, and if you are identifying certain problems you're running into with your syndication, even in your personal life when it comes to finances, just think outside the box as we talk through this, and just know that it's hard sometimes to change the way we think, and it's a struggle, and sometimes we have to just think outside the box and make that decision to change. And I love this other one, that says, hey, one day or day one. And we really need to get around to it. So with that being said, we're going to get started. I'm going to kick this off to Ryan. Ryan, thanks for joining us tonight.
Yeah, it's great to be here. Thanks for the invite, Jason. I'm excited to share with you guys. And you'll see that there's some letters next to my name. And I hope as real estate investors, you don't hold that against me, because I am first and foremost one of you, a real estate investor, a business owner, someone who uses the infinite banking concept on a daily basis in my own business and investing. But I think it is helpful to have a kind of comprehensive wealth management and financial planning background. So I am a certified financial planner. I have an MBA. I'm a licensed investment advisor representative. And most relevantly for this presentation, I am a specialist and life and health insurance agent, and really specialized, like Jason, with the cash value life insurance and using the infinite banking concept, or IBC. So I have done this with my own real estate investment projects. I've done it with a number of other similar types of investments and my own business. So again, I've got a pretty good comprehensive, a lot of depth and breadth, just like Jason. But I really want to emphasize, first and foremost, I am a real estate investor and business owner and practitioner of everything we're talking about. So everything I share with my clients is really stuff that I'm personally doing that is coming from a place of personal and professional overflow. And I think that's always going to be a better way. It's one thing to know about it with book knowledge and head knowledge, but once you start applying it experientially and personally in your daily life, that's when it really comes alive. So if there's one takeaway for you guys to know with all the acronym soup and the, different degrees and everything, I think it's most important that I am in the same boat as you. And I just became so passionate about this, like Jason did, that we wanted to tell as many people as we could. So I'll leave it at that for now. But again, thank you, Jason, for inviting me to do this. We're really excited to share this really amazing, uncommon knowledge with people. So I think a lot of people in the real estate investment space know about it, at least theoretically, but we're hoping to unpack and add another layer in this webinar. So I'll leave it at that for now. So thanks, Jason.
Yep. Yeah. So my name is Jason Powers, and I like Ryan. I love what I do. I eat, drink, and sleep this stuff all day long, and I love it. My past is, I've had a few different businesses throughout my life, and still do. And I heard about infinite banking about 10 years ago. Someone was talking to me about it. And so I called them, and they told me all about it. I learned it. I started implementing it in my own life. And fast forward, who would have thunk? I never would have thought I'd be doing it as a career down the road, and so I was practicing it well before I got into it as a career. And I just got into it on this side because I loved it so much. My real estate investing background, I started out way back in 2008, 9, 10 when the market crashed, got into wholesaling. I was watching friends and families lose their homes through this market crash. And it was so frustrating for me. And I was like, there's got to be a way for people to not get foreclosed on. Like, there's got to be some other options out there. And lo and behold, you don't know what you don't know. So anyway, that's what got me into real estate investing to begin with. Trying to help people in those kinds of situations, and did the wholesaling, did the fix and flips over time. Start buying a couple of rental properties here and there. Had a wonderful opportunity several years ago to buy a 170-acre former camping and recreation area. Start redeveloping that a little bit, and since sold that off, seller financed that off to some other guys, and they're carrying the torch forward, doing a great job with it. And so I've done my share of real estate investing, and the whole time it's been, man, everybody needs to know about the infinite banking concept. And that's not because I'm doing it as a career, like because I'm trying to sell you something. It's truly something I believe in, and that I think everybody needs to know about, and then find ways to apply that in their own life. So that's a little bit about me. And yeah, let's get started. So I think as we talk, there's this need for generational thinking. We've sort of lost that over time, over a couple of the past maybe 2 generations. Really, we think about that less and less and less. We just have this need for generational thinking. So think about that as we talk tonight. There's also this need for life insurance in general. It's a boring topic in general. People are like, oh, I don't want to talk about life insurance, or it's a scary topic, or it's uncomfortable. But there is this need for that, and this downside protection, which Ryan's going to talk about a little bit later on. There's also a need for disability income protection. I mean, just providing financial security, in the event of things like disability, and safeguard your investments and financial commitments. I mean, what would happen to you if you all of a sudden couldn't deal with, in any way, for a while, your real estate investments or your job, if you've got a regular 9 to 5 or any of that? So there is a need for this. But there's also, larger than all of this, I think, a need for controlling the banking function in our lives. And that's what we're going to really spend a chunk of our time on tonight, is just this. Why do we need to control the banking function in our life? Who cares? What's it matter? Okay, so you ready? Put your thinking caps on. You're gonna drink from a fire hose tonight, and but it's gonna be good. So let's kick this off. I will. Little disclaimer before I kick it over to Ryan. We're going to talk about a lot of different things tonight, but obviously we don't intend to give you specific tax, legal, investment advice. So seek your professional counselors in those specific areas for those kinds of things. But we are going to give you some great information and steer you in the right direction. All right.
All right. Well, I think, Jason, I believe this is where I was going to just talk about a little bit of downside protection and the need for all that stuff first, right? But before we get into that, one more caveat, just that even though we're using these life insurance policies, and I know we talked a lot about infinite banking and IBC and haven't actually defined it yet, but before we get to that, just want to make sure that the primary purpose of life insurance is for death benefit protection, and all other benefits are purely ancillary. That said, a lot of those other benefits and those ancillary features are pretty important. So, but before we get to that, just most people understand life insurance in its basic form, which is just downside protection. If you were to die, most people probably think about it in the personal ownership sense, but there's a lot of really great uses for business owned or company owned life insurance, sometimes called COLI or COLI, company owned life insurance. And if you have a syndicate, and again, we're really focusing this particular presentation on general partners, capital raisers, and syndication business entities. So as you probably know, key person protection, right? So if you or one of your key members of your team unfortunately had a premature death or disability, that will greatly affect the ongoing success or profitability of the business. And I've noticed that as one myself, and networking with other LPs, or limited partners, passive investors who are putting up the capital, the savvy ones are asking more and more about this. And so that's something you should really be prepared. If somebody says, hey, what happens if something happens to you or your team, or is there any protection in place? And if the answer is no, that might be a tiebreaker, right? So that's important to know about. That's one function of life insurance in a business context. Then there's a buy-sell, right? You've got a buy-sell agreement, hopefully, which is a legal contract, but then you need a funding vehicle for the buy-sell, and life and or disability insurance can be a phenomenal vehicle for how to fund that if something does happen. So to buy out the partners, so you don't become de facto in business with their wife or their kid or somebody else, right? Now, the one we're going to focus on mainly for today is being able to have a debt payoff for a loan. So this will pay off the business's debts. And obviously, if you're doing a big, large scale syndication project, you probably have quite a bit of debt. So that's going to allow for a lot of underwriting and some pretty great ways to structure the policy potentially, especially for capital intensive businesses like real estate. And then even though we're not going to get into it as much, there's some really cool ways you can structure deferred compensation and executive benefits. That could be maybe a webinar for another day, and possibly stock redemption if it's like a corporation. But again, today we're really going to focus on using the loan portion of this. Now, for GPs and syndicators, one of the, like we talked about, most important things is protecting against the premature death or disability of a GP, particularly if you've got, a multi-million-dollar debt on a large scale project. And then again, that can be a differentiator for your business model and a demonstration of your professionalism that a lot of people don't have. And that could lead to enhanced capital raising capabilities, a tiebreaker, so to speak. If you're, trying to raise capital from limited partners and they've got a bunch of different options on the table, I imagine right now, particularly commercial real estate's a somewhat difficult time to be raising capital with the environment we're in. That could be an important differentiator that could get you, that investor, on board versus somewhere else. And then it can also be a balance sheet asset if cash value policy is used. And, you can do this with the term only policy, but we're going to get more into infinite banking and cash value policies later on in this presentation. Now, for LPs or passive investors, this is important to know. And if you're a savvy GP, you should be probably thinking about things from their perspective. The big benefit of the downside risk mitigation is the protection of their investment principal, mainly because, as anybody who's been in this game for a while knows, the jockey is almost more important than the horse, so to speak, when it comes to real estate, private equity, private placement deals, where there's a very heavy reliance, almost exclusive, total reliance on LPs, on the management team and the people doing the day-to-day operations, right? So that's going to give the LPs peace of mind, or the swan test, sleep well at night, which, again, if you're thinking from the perspective of the people you're trying to get on board that are bringing the capital to the table, then that's probably important for you to be thinking from their perspective and be able to address those potential concerns and address the ways that life insurance in general can benefit them.
So we'll kind of back up and give you a high level view now, and now start introducing, why do we have this need for controlling the banking function in our life, and then we'll drill back down into this. So Nelson Nash, which we'll reference time and time again throughout this presentation, and as you talk to us over the coming weeks, but he says, hey, if some authoritative power distributed all the money in the world equally among all the people in the world, within 10 years time, all that money would be back under control of 3% of the people. Well, why is that? Well, it's because they understand money and how to get it to flow to and towards them instead of away from them. Okay. And so that's important. And I think as real estate investors, we want to learn that, right? Obviously, to be good real estate investors, we need to learn how to get that flow of money flowing back towards us instead of away from us. So we talk about money a lot, and I like to just kind of bring up this question, get you thinking, when it comes to your money, think about, what would you like to do with it? How much would you like to have? When do you want it? But more importantly, why? And I ask people all the time, what is your why? What's your why? Why are we doing all of this? And so think about that too as we go through this, and underlying, yes, we want to make money, but why do we want to make money? Yes, we want passive income, but why do we want passive income? So on. So yes, we want a legacy, but why? Think about these questions, and even if you don't know the answers, it's time to start thinking about it, I think. And as you develop the answers that you for yourself and your own life and your own situation, I think you'll start seeing the problems financially in this country too, and then when you start seeing the problems, you'll know what to do. So let me talk about a couple of human behaviors. First one, Parkinson's law, my favorite. There's three components to it. Okay, work expands to meet the time envelope allowed. What does that mean? Let's use a contractor example. So if I hire a contractor to remodel a bathroom and I say, hey, you've got a week to get it done, and he gets it done in a week, great. And then a month later, I get another property, or he's moving on to the next, apartment. And I say, hey, we've actually got a month to do this one. Same bathroom, same size, same remodel. But he can do it in a week. How much time is he going to take to do it? If you gave him a month, he's going to take a month to do it. But that's just human nature. We do that. Work expands to meet the time envelope allows. So he could have done it in a week. It would take a month. So anyway, the second component to that is a luxury once enjoyed becomes a necessity. What do I mean by that? I was talking to somebody a couple of weeks ago, and she made the comment about her remote start. We're in Colorado, and it's during winter time, it's freezing and it's snowing, and she's like, I love my remote start. She's like, I will never get a car again without remote start. And so, right. So now she's got this luxury, and now it's a necessity. Or when you first got a house with AC, would you ever move back into a house without AC? Things like this, you get it. And then the third component to it is expenses rise to equal income. As our income rises, we tend to change our living situation or what have you, and our expenses rise with it. Okay, so that's Parkinson's law. But why do I talk about it? Because this is something that has to really become overcome daily. We really do. It's a daily activity almost to overcome this type of thinking when it comes to our money. But we're destined truly to become a slave to that money. And we can never get ahead because we'll constantly be playing catch up. We'll constantly be spending all of our money, every last penny of it. We'll constantly be in this state. But like Nash says, the good news is if you can whip Parkinson's law, you will win. So who's really in control of our money? So we finance everything we do in life. Okay. Credit cards, mortgages, we get loans, we borrow for our car, we put our money into someone else's control. Who's one of the main characters in that story? Well, it's the banks, right? The banks play a huge role in our life. And that's what we want to teach you tonight, is just learning to control your money. What if you could be the bank? What if you could finance your own deals? What if you could have a system set up where you are your own privatized family banking system? Okay. So that's what we're going to talk about tonight. The second law I want to talk about real quick, Willie Sutton's law. I like this one. He was a famous bank robber. If you don't know who he is, he's a famous bank robber. He got caught, and so some reporter was asking him a question one time. He's like, why do you continue to rob banks? And he said, well, that's where they keep the money. And so very simple answer. But the basic principle behind this one is, hey, wherever wealth is accumulated, someone will try to steal it. Okay. And so without getting political, I ask, who's the biggest thief in the world? Who's the biggest thief in the country? And that's just something, that's why we want to control the banking function. We are constantly putting our money in control of other people, be it the investment climate, be it the banks, be it the government, be it, we're putting our money in control of other people. How do we regain control of that? So enter the infinite banking concept by Nelson Nash. He came up with this idea a long time ago and put words to it via this book. This is like a 92-page book. If you haven't read it, read it. I'm going to give you a link at the end where you can buy it and download it. You can buy a printed copy, whatever you want. But so what is the infinite banking concept? Well, I'll tell you what, it's not some financial hack where we take control of the banking function in our life. It's not a hack. It's just this is a way of life. This is a way of thinking. And we want to change the way we think about our finances and learn how do we take control of that banking function. So infinite banking concept is the best place to warehouse your wealth, has guarantees, has safety, has ready access to your money, not stuck somewhere else. And it allows you to take over the banking function in your life. Okay. So again, buy the book, read it. It really is going to drive in why the infinite banking concept. Okay, 5 quick rules, which we'll talk about a little bit. Taking the long view. I joke, real estate investors, we are a conundrum because we are some of the most patient people in the world because we have the ability to think long range. Let's take the long view when it comes to buying multifamily properties, buying single family properties and stacking up and building for passive income over time. That requires thinking long range. It requires patience. On the flip side, we're some of the most impatient people that I know. We want access to all of the money now. We want the biggest deal and we want it done now, right? So we have this kind of quandary going on, but for this, you really need to be thinking long range. Also, don't be afraid to capitalize. Once you see how it works, I think you will not be afraid to capitalize your system, because you will understand it and you will go, oh my gosh, well, how much more money can I put into this? Truly. Just don't steal the peas. My favorite reference from the book, in short, be an honest banker. When you are borrowing money against yourself, pay yourself back. You wouldn't steal money from another bank, so don't steal money from yourself. Pay yourself back. Don't do business with banks. If you control the banking function, don't do business with banks. Now we like leverage, we like real estate. So, but the principle behind it, if you can control that banking function, and also, which I've already alluded to several times, rethink your thinking. Okay. So, the vehicle, which I'm going to kick this over to Ryan.
So when we talk about infinite banking and all these things that Jason just went through, what specifically is that? Well, it is a properly structured, dividend paying, whole life insurance policy from a stable, highly rated, solvent mutual insurance carrier. And those are all important things. And when you talk to different agents about this, you really should understand the difference between a stock company and mutual company, participating versus non-participating. There's a lot of different details. We're not going to go into all of the weeds right now, but at the end of the day, we're taking, again, we talked about life insurance at the beginning, protecting against a downside risk, which everybody's familiar with for the most part. But what we're really getting into now is how we can build wealth as well as protect it simultaneously. So that's the vehicle. It's been around forever. There's nothing new necessarily, but it is really important how you think and how the policy is structured and how you integrate it into a larger, more comprehensive financial plan and integrated strategy.
Yeah, I love it, Ryan, how this, I put this on here all the time to show people, like, whole life insurance has been around since the 1700s. This is not something new.
Right.
When we talk about properly structured, as you just mentioned, it is not structured like, as we would say, your grandparents' old life insurance policy. It
Right.
is structured different, more efficiently for you and your needs, so you can have ready access to your cash value now. So as we talk about whole life insurance, take kind of your stereotype understanding of whole life and throw it out the window, and let us explain the properly structured dividend paying whole life insurance from a mutual carrier and what it will do for you. I love it. It started 1700s. It was called the Corporation for Relief of Poor and Distressed Widows and Children of Presbyterian Ministers. Say that 10 times fast. That's actually a shortened version. It started because ministers were supported by the church. And then upon their passing, they were no longer supported by the church. And suddenly these families were left destitute, their spouses, their children, and so forth. And so this actually got started out of that idea of how do we continue helping the families even beyond this person's death. And it still does that today, but companies carry cash value whole life insurance. Interestingly, banks carry billions of dollars in cash value whole life insurance. There are some of these banks on the screen that actually own more in cash value whole life insurance than they do in real estate. And that's a fascinating thing to me, because then all of a sudden they start going, well, wait a minute, what do they know? What are they up to? Okay. Fortune 500 companies, they get it. They've used it. They utilize it. Fun stories as you start digging around and seeing who's used it throughout history. Walt Disney, for example, he couldn't get enough of a loan to finish building a theme park in California based on a mouse. And so he borrowed from the cash value from one of his policies and helped fund this thing they call Disneyland. Ray Kroc, when he bought out the McDonald brothers, he actually had two different cash value whole life policies. He used one for pay some key employees. He had also used it for a marketing campaign on his newest mascot. Any guesses? Mr. Ronald McDonald. And so it's just kind of fun as you dig around and you start seeing, hey man, if these guys didn't have policies like this, I wonder, would Ronald McDonald even be here today? If without something like this. So as you dig around in history, you start seeing who's been using it. Certain dignitaries, they knew about it. They know about it. Interesting article came out on President Biden when he had to disclose his finances several years ago. Talked about how he owns 0 investment products and 6 whole life policies. Well, was a mind bender. All of a sudden, you're like, well, wait a minute, he's not broke. What's he up to? What does he know? What's he doing? And we don't know what he's doing with it. But the fact that he had 0 investment products and 6 whole life policies is pretty fascinating. So that's my point. What are they doing? So we have this wealth of common knowledge that we're taught, and then there's this whole world of uncommon knowledge that the general public sector doesn't really get taught. And then we're suspect, right? When we hear about it and we've never heard about it before, and we're like, well, how come everybody doesn't know about this? Because it's awesome. We hear, Ryan and I hear this every day, right, Ryan? We every day, like, why? How come everybody's not doing this? Truly, and it's totally not a sales gimmick. It's like, it's so fascinating that the more people don't know about it. Every day we talk to people and they're like, why on the earth? So some of the features we're going to zip through real quick. I'm going to hand it over to Ryan after that. We're going to have this really great in-depth case study, and just dive in. So as we look at these examples, don't always think about how do we come up with extra money, ... More often than not, it's about how do we change the flow of our money. Okay, so think about that as we talk through infinite banking. And we help you figure some of that out as well. People who are ready to get started, that's part of our job, is help you look at the whole picture and look at how do we change the flow of our existing money. We don't want to change your real estate investment strategies. We want to change the flow of the money. And by changing the flow of the money, you've done turbocharged your strategy, So I think one of the single greatest benefits is the fact that your cash value will grow uninterrupted throughout your entire life, even while you're using it. What do I mean by that? I mean, if I have a pile of money in a savings account, let's say, and it's growing now, what do we got? These, high yield accounts at 4 or 5%, and let's say I got $100,000 sitting in there and I pull 50,000 of it out to use it. It's only growing at that 5% of what you've left in there. Makes sense? So you've interrupted the growth. In this kind of vehicle, it will grow uninterrupted. So if I pulled that 50 out, it's growing as if the 100 is still in there. And there just is not another vehicle out there like that. Okay. So this can address
one thing to that, Jason, since we are talking to real estate investors, just to help them get a basis for comparison, and we'll go into this more, but it's very similar to, rather than liquidating an investment property that's performing, that's tax efficient, it's giving you capital growth and cash flow at the same time, all these great benefits, right? Rather than selling the property and liquidating it, which is one way to get the money, you could also collateralize a loan against it with, say, a HELOC, a home equity line of credit, that is a very flexible, open revolving line of credit, which is the closest analogy that I think I could give a real estate investor that's hopefully familiar with that. You do the same thing with this life insurance policy. We'll go into it more, but that's such an important point that we're going to hit on multiple times. I just thought that might help. Every time I present to real estate investors, I think they intuitively can grasp that concept. And then you can scale your property portfolio much quicker when you're doing that, as opposed to, like Jason just said, selling it, starting back over at 0, building up, and doing that over and over. So I think that's just a really, really powerful and important concept to understand.
That's right. Yeah, it addresses a lot of lost opportunity costs, which we're not going to camp on right now. Income tax-free growth, when accessed and utilized properly, it's a vehicle that you can utilize now. You can even supplement or be your retirement later. Furthermore, income tax-free when done properly, which we'll show you. It is not an investment product. It is safe from investment booms and busts. As we're talking about tonight in the context of infinite banking, we're talking about whole life insurance. It's an asset. It is not an investment product. So there aren't investment booms and busts. Loans, when you borrow against these, are not tied to your credit. Unstructured loans, furthermore, how many of you would like to take a loan and the lender says, hey, pay me back when you can? I would love that bank all day long. So if you're your own bank, it's an unstructured loan. But back to one of the 5 principles of IBC, the 5 rules, be an honest banker. So we do want to pay it back, have a means of paying it back at some point. It's a multitasking dollar, which we'll hit a lot, through example. It's doing multiple things at once. Okay. And then finally, it's this generational wealth transfer. We are talking about life insurance. And so we really want to I mean, there's this vehicle, this amazing vehicle that'll do so many things for you throughout your life, but then you can have this generational wealth transfer throughout your life. And I love the fact that we can use that throughout our whole life and help us make money or save money. And then we can also use it to supplement retirement. And then we can also use it to benefit the next generation. And when done properly, multiple generations after that. And that's my favorite part. We're not going to talk about it tonight, unfortunately, but I love just the multi-generational aspect of this vehicle.
Yeah, that's a great, there's so many, it's such a rich concept and strategy, but hopefully you guys can see my screen now. Jason, are you able to
Yep.
see my screen as I take over here? So we talked about a lot of things, and some of these things we're saying the same thing, just multiple ways, because it takes many coats of paint, so to speak, to really understand it. But we talked about the downside risk protection and mitigation benefits of life insurance before. Now we're going to talk about some of the upside benefits, specifically with cash value infinite banking policies. So besides just the death benefit, which is really important, especially for that multi-generational, legacy approach that Jason was just talking about, you also have this additional return component from the growth of that cash value inside the policy, which again is growing uninterrupted, that compounding over time. You don't need a super high rate of return when you can put a huge amount of volume and, most importantly, many, many decades of uninterrupted compounding, exponentially building your wealth over time. You also have, specifically with whole life insurance, safety and predictability, because we're probably taking quite a bit of risk in our real estate portfolios or our businesses or both. And this gives you some diversification and a lower risk profile while still greatly accelerating, your wealth building capacity over your lifetime. Another aspect is that it's non-correlated or, again, diversified, so that, typically I find business owners and or real estate investors are very passionate and good at what they do. They're very savvy, creative outside the box, but they tend to be hyper concentrated. As unfortunately I've seen with some of my clients who, when things didn't go as well, when interest rates shot up recently, that if you can have, different risk profiles, and again, that money working in multiple places at the same time, maybe one of your deals doesn't go so great, but at least you got the money in the policy, and the long-term benefits of that in a well-structured plan are going to be amazing. And that can potentially mitigate some of those losses and create some additional returns that can be used to maybe buy another property or do another deal that does perform well. Then tax efficiency is tax efficient as real estate is. Probably with a well-structured life insurance policy that's called a non-MEC. A MEC stands for Modified Endowment Contract, and that's important that it's structured the right way, back to what we said earlier. As long as that's the case, then if you structure it and use it correctly, then you should never have to pay any taxes on the growth, and you can even get a tax deductible interest expense if you're using it for a qualified purpose like business and or real estate investing. So you add all that up, and that's a really powerful combination of factors. But the key, again, is the way that you structure this. And unlike traditional insurance policies, like Jason alluded to earlier, where you're minimizing premiums and trying to get the maximum death benefit, with an IBC policy, you're doing the exact opposite. You're trying to maximize the premium. That comes back to capitalizing your banking system that Jason talked about earlier, and minimizing the death benefit at a given level. Now, that sounds totally backwards. Why would you want to maximize premiums, minimize death benefit? Because the less death benefit that you pay for, as long as you have what you need, that's going to optimize the initial ability to access cash value, as well as the rate of growth of that cash value over time, which is really where we get into these ancillary benefits that we talked about earlier. So that's just, it's kind of turning things on its head. And in fact, it's important to ask the agent who's selling you the policy how they're compensated. We're very transparent about the compensation structure. With your granddaddy's whole life policy, if you will, the standard structure, all of it goes to what's called the base premium, and that's where the agent makes a lot of commission. What Jason and I do, and what we do in Unbridled Wealth, is kind of try to cut our own commission to the bone so that we can maximize the amount of cash value that people like yourself have access to. And that doesn't sound like a winning combination, but if we do the right thing for the client, what we found is that we more than make it up on volume and referrals and that implicit trust that comes with that. So again, there's a lot of components that go into this. We don't have time to cover everything, but it's just, I cannot overemphasize enough how important the right structure of the policy is. And then outside of that, the right overall strategy and planning to use a well-structured policy in alignment with your goals and objectives. So one of the most important things about the infinite banking concept is not just how we structure the policy, but it's how we access the capital. And the key here is that we're borrowing versus withdrawing the money. So when you're doing that, just like with the example of a HELOC, where your real estate property is appreciating over time and generating greater and greater income with inflation as you can keep increasing the rent, then you're getting this amazing compounding effect. So when you can earn compound interest but pay simple interest, a lot of people don't explain this who are IBC specialists, and this is something I actually did a model on a spreadsheet to see just how powerful this was. And even if you're earning a lower rate of interest, say 3.5%, but it's compound, and let's say you're paying 5%, it sounds like you're behind, and maybe you are at the beginning a little bit, but over time, that difference is absolutely exponential when you can earn compound and pay simple. So if nothing else, that could be worth the price of the ticket for this whole webinar right there. And again, even at the same or a lower rate that doesn't look on paper like you're making money, that is such an important concept to understand. But luckily, we also have this thing where typically we are getting what's called a positive arbitrage, where we're earning a higher rate and paying a lower rate. So potentially you could be earning, say, maybe 4.5 or 5% long-term and paying potentially 4% if it's the right lender. And, obviously a lot of that depends on the interest rate environment. Right now it's a little tougher, but typically the life insurance policy loans through the carriers can get accessed at much lower rates than prime or sometimes even Fed funds rate as the case right now. And then you profit from the spread. So that's powerful. Then we add tax efficiency on multiple levels to this as well, where you're earning compound on growth that is not taxed while paying simple interest that is tax deductible, again, if it's for a qualified business or investment purpose. And that's beyond the scope of the conversation here. If you really want to dive into the weeds, you can Google the interest tracing rules as part of the Internal Revenue Code. But that you start stacking these things up on top of each other, and it adds up so much. But again, coming back to this multitasking dollars that Jason hit on that I kind of interjected earlier is so important, because I don't know about you, Jason, but almost all real estate investors that I initially talked to about this, they're like, okay, you definitely put a new wrinkle in my brain. This is clearly better than a savings or, a typical cash account or vehicle that I would use to fund these deals. But why would I settle for, say, a 4 or 5% long-term return when I can get 20, 25, 30% plus in some of my real estate deals? And emphatically, we're not saying to replace the real estate with the policy. We're saying to fund the real estate with the policy, essentially replacing your checking or savings accounts as the place that money flows. And that's where Jason talked about earlier, redirecting the flow of your money, insourcing the banking function in your life. That's how you do that. So you can get money working in multiple places. I put 2 places, but you can, if you really do this, in multiple levels, you can get $1 working in many, many places at the same time. So again, real estate and the policy at the same time is a great example. Emphasizing again, the policy is not the investment. It is the funding vehicle that capitalizes the investment. So the policy funds and protects the investment, possibly through like a real estate special purpose acquisition vehicle. So I'm going to stop there for a second because I know that was a mouthful, and say, Jason, do you have anything to add to any of that?
No, I think that's great. I think just capping off what Ryan said, it is about changing the flow of the money. Like you said, we're not changing the real estate investment strategies. We're changing the flow of the money, and there's a difference. So just again, and we're getting ready to dive into a pretty heavy duty case study here, and it's I think a great example of just how do we start thinking about that flow a little bit different, and what does that do for us?
Right, exactly. That's exactly what it is. And so when we get into this case study, I don't want you guys to get too wrapped around the specifics of the deal. I kind of just constructed a hypothetical. Now, I'm fairly familiar with multifamily value add projects, but I'm not a syndicator myself. So again, you probably could make up better numbers than I did, but I'm just trying to paint a picture that's specific enough you can wrap your hands around, but also not so specific that it becomes counterproductive. But in this particular hypothetical example, it's a multifamily value add property. We're going to start off at the beginning, or year zero, if you will, with a $35 million property acquisition. And of that 35 million, $25 million is going to be financed by debt. Usually that's an interest only bridge loan from a specialty lender. And that, in this case, we talked about earlier, the different ways that business policies can be underwritten. That's going to be the assumption that I use for this case study, is that the $25 million debt, that's what gives the insurable interest, as opposed to a key man policy or buy sell or something like that, all of which could be completely legitimate ways. But in this example, this seemed to make the most sense. Then we're going to have $15 million of an equity raise. And again, maybe this isn't the perfect example, but I just assume the majority of that 14 million is going to come from the LPs or the limited partners and passive investors. And hopefully if you're a GP and you're raising capital, you got enough of your own skin in the game, right? That's another thing savvy LPs are going to ask about. So let's say that you're putting $1 million into this. Of that $15 million equity raise, $10 million is going to go towards the down payment, which gives us about a 70% LTV, fairly conservative. And then $5 million of the $15 million will be a capital expenditures budget, or CapEx. And of that $5 million, $1 million will be more of a contingency fund, we'll call, which isn't necessarily meant to be dipped into right off the bat. It's just there if you need it. It's kind of like a break glass in case of emergency. And that $1 million is where that policy premium is going to come in. And so we're also going to assume that this is a 7-year project, and that the property level cash flows on average are going to be about, say, $4 million in gross receipts. And after all the expenses and debt service, you got about $1.5 million, again, on average. Those numbers are going to change every year, of net cash flow, of which pays the ongoing premium. So $1 million premium the first year came from the GPs, and then the ongoing premiums in this hypothetical example come from the property level cash flows. So before I go any further, Jason, any questions, thoughts, feedback about just?
No, the only comment I would say, which is pretty typical when we have these conversations around big dollar amounts in real estate, specifically your business owners, otherwise, is like Ryan's alluded to in the beginning, don't get caught up on the number of zeros. It's understanding the principle behind it, what it's doing, how it's growing, why it's growing, what it's doing for you. You could take 2 zeros off of this example. You could add 3 more to it. Functionally, it's the same. Okay, so don't get caught up on the number of zeros.
Yep, that's a great point. That these property, policy characteristics, if you will, scale generally proportionately, not perfectly, but within a range. There, it could be $100,000, it could be $1 million, it could be $10,000. That's a really good point. And so again, I'm just using as round numbers as possible and trying to make it kind of institutional level scale, if you will. So again, that's where the sources and uses of funds are coming from. And then when we get into, we're going to assume that somewhere between end of year 4, beginning of year 5, you're going to get a cash out refinance. You've generated some forced equity in the property by increasing NOI, the net operating income, and that's forcing appreciation. And you're going to refinance that interest only bridge loan to maybe like agency debt that's fully amortized. And that's going to generate, in this example, again, I'm kind of just using rough back of the napkin math from other deals I've seen and pro formas I've actually looked at. Let's just say that, in that time frame, hopefully if you're doing a good job as a GP, then you're generating some pretty significant value there. So we'll say that that property that started at a $35 million valuation has now gone up to $47.5 million, which has generated an additional $12.5 million of tax-free capital. And that in itself is almost an example of the infinite banking concept, just in a different context with real estate, right? You're extracting liquidity tax-free from a loan rather than selling the property, even though you could do that. And of that $12.5 million that's generated from that cash out refi, $10 million is going to give the limited partners their return of capital. And so they're getting most of their money back beyond the property level cash flows on an annual basis. You've gotten most of their money back. And that extra $2.5 million of the $12.5 million is going to repay a policy loan. And I'll explain more the policy level cash flows in a little bit. And then we'll call it end of year 7 is the full cycle, disposition or sale of the property. And let's say that's another 12.5 million. You've gotten this property up to $60 million from the 47.5 million it was before. And that's pretty good. I don't think that's outrageous. You started at 35 million after 7 years, getting it up to 60 million. That's totally doable from what a lot of, historical, different deals I've seen in this type of multifamily value add strategy. That gives the LPs their final distribution. And here's the kicker for the GPs. And you could structure this any number of ways. I just had to pick something. Years 8 plus, the policy can be used to give distributions or retirement income or supplemental capital, however you want to use it, to the GPs. And as you'll see with this particular example that we use, you're going to be starting off with $5.4 million of net cash value, and that's going to increase tax-free guaranteed every single year. And that's what's really powerful is those later years. So I'm going to stop there before I dive into the policy real quick and say, Jason, any other feedback or comments on up to that point?
No, I would just say that $5.4 million, we're going to expound on that in the illustration side a little bit. And so that'll make sense here in a minute.
Yep. And that's actually what this is right here. So when I talk about, we just talked about the property level details, the project itself. Now we're going to dive into the policy itself. And this is going to require some assumptions. We're going to assume a 45-year-old male with the preferred health rating. That's not the best, but it's good. They're in decent health overall. But, we're not shooting for the moon here, and we're not, trying to cherry pick. So this is going to, I think I need to, so in this particular example, just to make it kind of simple, round numbers, it's going to be a $1 million annual premium for 7 years, and then nothing again ever after that. And again, the beginning, that first $1 million premium in year 1 was funded by the equity raise, and then the property net cash flows ongoing is what continues to fund the rest of it. So we're going to take some policy loans here, and we're going to, we are going to incur some interest. And unlike a lot of people say, you're not paying yourself that interest. That is a hard expense. It's either going to the insurance company or an outside lender. You can get a third-party line of credit, which is pretty cool. It operates almost identically to a HELOC. Either way, that is a hard expense, but you are retaining the compounding effect, which is how we insource that banking function. So in year, and actually, Jason, I'm just going to switch over here to another tab and just show the basic policy before we get into the loans. I'm going to switch over to this tab. And can you see this policy illustration here?
Yep, we got your emeritus illustration there.
Right. So, and it doesn't have to be, we just happen to use this carrier. We're familiar with them, but this is how we, can just look at this. I think a picture's worth 1,000 words. So, $1 million premium for 7 years, and then you can see nothing again. And then the accumulated outlay obviously is just adding, $1 million the first year plus $1 million the second year. That's your $2 million, $3 million, et cetera. By the end, you've put in $7 million. And you can see by the end of year 7, you're slightly break even. You're a little behind at the beginning, but not much. I mean, this is a pretty efficient policy structure. You can see year 1 right off the bat. And the way I structured this, in case you're wondering, was pretty aggressively, again, tilted in favor of the client and policyholder, not the agent. This is a 85% paid up addition and a 15% base premium. We're not going to get into all that, but in case that comes back later and you're wondering how we got this much initial cash value, people are kind of shocked when we put these illustrations together. You can see that, in that first year, you've got 82% of what you put into this policy available. Now, you're probably going to be able to get access to about 95% loan to value on that 820. But I mean, you're right around 80% right off the bat. Whereas again, your traditional whole life policy that's base only, that's really stacking things in the favor of the agent's commission, it's going to take many, many years, if not decades, to get to that point. And we're starting off already very, very high access to cash value in year one. So you can see this also has almost a $19 million death benefit. And then that goes up every single year as well. And so you can see these numbers here going up. You are slightly behind at first, especially when we add in the interest. But what's really amazing is that if you look at what happens after year 7, you're never putting anything in ever again. And this is a pretty cool thing to see. Can you see the cash flow from policy here? Is that showing up, Jason?
Yep, we got that.
So look how much the cash value is increasing. You can see you're slightly negative cash flow these first 3 years, right? You're putting in $1 million, you got 820. Putting in $1 million, and that year it went up by 952. So you're almost break even by the end of year 3, but you're starting to get ahead of the curve on an annual basis after, at the end of year 4. But what's really amazing is that you put nothing in ever again. You've got almost $380,000 of tax-free passive income, and that just goes up and up and up every year. By, in this case, the person who was 45 to start off with, when they are 30 years into this policy, that's kicking off over $1 million a year of tax-free passive income, and you haven't paid into this policy for decades, before that. Yep. So I think that's really important to see how this works on an annual basis as well. And then the next thing that I'm going to do is show you again. So remember, we're capitalizing this, but we don't want to be afraid to borrow against it. Now, again, in this hypothetical example, and I'm going to go back to the, the PowerPoint, which hopefully that's coming through, Jason, on your end, right?
You got it.
So again, this is meant to be more of a contingency fund than an immediately used operating expense fund. But if you need to dip into it, let's just assume that the first year we weren't planning on having to do anything. We already dipped into our $4 million of the CapEx fund, and now we're dipping into even that $1 million emergency fund, if you will. But that's okay. Now, in this case right now, in this product, you can borrow at a guaranteed 4% interest-only rate, which again, like I said, is well below. I mean, prime is at 8.5% right now, which means most HELOCs are in the mid nines. To be able to guarantee an interest rate of 4% interest only unstructured is pretty amazing. So that first year, you're going to have a $500,000 loan in this example. That's going to be $20,000 of interest expense at that 4% interest only.
So just to reiterate that, when you get policies at the time of issue, in this example, this Emeritus policy, that product, they have a fixed 4% rate option to borrow against your policy for the rest of your life. As long as you have that policy, you always have the option to do a fixed loan at 4%, regardless of what interest rates are doing outside. Right. And that's just an amazing feature. Now you do have the option in this product to do a variable loan as well, which there will be a time where you would switch over to variable, but without getting into that right now, variable rates are higher. And so the first few years, you're definitely going to do the fixed. And so, but just to have a vehicle like this growing at that kind of rate throughout a lifetime, and to always have the option to borrow at 4%.
Yeah, that's an amazing point. And I am going to show in this example for exactly that reason, Jason. There are some trade-offs to that, right? So the first couple of years before there's much of the dividends, I'm not going to get too much into direct recognition versus non-direct recognition. Those might be things to Google and become familiar with. But the one downside of the fixed loan is that it is going to potentially impact how much interest gets credited to the dividends, which adds up greatly over time. So in the beginning of this example, when the dividends aren't that much, that's where we're going to lock in, where we're getting things off the ground. It's a brand new startup stage. We want to stack the deck in our favor as much as possible with that really low guaranteed interest only rate. That's going to help. And then as you'll see here in this example, the first 3 years you're going to be borrowing at that 4% fixed rate, right? So year one, $500,000. Year two, you're going to borrow $1 million right? So you got a $1.5 million cumulative loan balance at this point. Again, at 4%. In year 2, you're going to pay $60,000 in interest expense, right? 4% of 1.5 million is $60,000. Same thing. Year 3, you're going to borrow another $1 million. You've got a $2.5 million cumulative loan balance. Again, at 4%. That year is $100,000. Now, starting in year 4, we mentioned in this hypothetical example, that's where your cash out refi would happen. So the 10 million of the 12.5 million gets paid directly to the LPs. The 2.5 is going to repay that entire policy loan. So you're wiping that out. And this is where we go to the variable loan, because this is the point at which the dividends are starting to add up significantly to where we don't want to, we're willing to pay a little bit more, not much. In this case, still the variable loan rate in this particular example, although this is a real life policy and product, is only a little over 5%, 5.05% to be precise. So still not bad, but that's going to preserve the compounding of the dividends better than if we stayed at that fixed 4%. So you, again, like Jason said, you have total flexibility and if, when, and how much you pay yourself back, but you want to plan to be, paying those loans eventually. And so we had a capital event with that cash out refi. We used a portion of it to repay the policy loan to keep that interest expense from ballooning over time. And so then you'll see that that interest expense drops down because we still are going to borrow, even though we're paying $2.5 million back, we're going to borrow another $1 million in year 4, and same thing year 5. And this, I know this is hard to follow right now. I'm going to show you on the actual illustration how this all adds up. But you can see for borrowing this much money, even at variable rates, it's not that bad if you're looking at this interest expense, right? And then year 6 and 7, I'm going to assume that you've got enough efficiencies generated at the property level that it's pretty much funding the, you can put the $1 million premiums into the policy without having to necessarily borrow against it. Again, this is really designed as more of a contingency fund. And so basically in any given year, you're not paying more than about $100,000 of interest. And so your total interest over this, 7-year time frame is about $535,000. And again, if it's used, like in this case, for a qualified purpose, then that interest is tax deductible, which is helping you, while meanwhile, the cash value in the policy is compounding tax-free. So I'm going to switch over to this tab and show the policy outlay. If you can see that, Jason.
Yep.
So this is just showing you in the actual illustration itself, that first year you had $1 million premium, you borrowed $500,000, and at 4%, that was $20,000 of interest. So this is just showing exactly what I just put in the PowerPoint, and you can see how all those numbers add up. Now you can see that in year 7, we have what's called this RPU. That's a reduced paid up. That just means you're not going to put any more money into the policy. The death benefit is going to go down, but that's okay. And you're not going to put any more premiums in. And at that point, we are also going to extinguish the $2 million loan that was outstanding at that time. And you'll see that you still have at that time $5.4 million of cash value. That's where that came from. And if we go back to this tab where I showed all this stuff, and then we talked about, that's just showing basically what I just showed there. But we talked about, how in years 8 plus, the GP policy distributions, we're starting with that $5.4 million net cash value, and that's increasing every year. You can see that in this example here. And by year 20, assuming you haven't borrowed or withdrawn anything, that keeps going up every single year. And by the time this GP is at the ripe old age of 97, there's $37.7 million of cash value. And all you put in, not including even including the interest that you paid in those first couple of years, was $5 million. So you don't need that high of a rate of return. You can see your net IRR on the surrender value there is a little over 4%, but look how much tax-free wealth that generated over that time frame. And if you make it out to the ripe old age of Moses here at 121, that just keeps skyrocketing over time. But that's, I think this is a more realistic example, and I'll stop there for your feedback, Jason.
Yeah. Now, Ryan, talk about, in the first 10 years of this illustration right here, where we RPU.
Right.
Talk about tell us, you mentioned they extinguish the loan.
Mm-hmm.
Can you expound on that for us?
Yeah, so there's a couple of different options when you go to that what's called that RPU stage, that reduced paid up, where you're no longer going to put any money into the policy anymore. Now that is an irrevocable decision, so you want to think about that long and hard before you do that, because like Jason said, you're probably getting to the point where you understand this. You're going to want to keep putting more and more in over time. But in this case, we just wanted to show you a clean example, 7 years, and that's it, to align with the the scenario and the policy. And you can see here that now, these numbers here, the cash surrender value, this is net, right? That's including any, interest, any principal. So you're seeing that after that RPU, see how the death benefit, it got up to as high as $30 million here in year 7. And then it drops way down to 12.7 million. Well, at that point, you really don't need any death benefit because the project's already, the risk is over, the debt's paid off. So that's how you're able to do this, is the death benefit goes way down, which is saving you cost of insurance. And you basically used a permanent withdrawal at that point to pay off that $2 million loan balance. Again, you see here, the loan balance went up, 500,000, 1.5, 2.5. Then it got paid down a little bit. We ended at $2 million. And then you see it goes down to zero here. That's because of that extinguish loan feature option. You could keep the loan ongoing, and that will compound even more. And those numbers are pretty impressive, but we just kind of wanted to show you a conservative example of paying this loan off, dropping the death benefit, never paying any more premiums. That kind of just gets you to the point where this is now just a pure retirement or supplemental income distribution factory, if you will.
And I love the fact that, when Ryan talks about extinguishing the loan, it's extinguished internally.
Yes.
So it's not extinguished via outside $2 million paid it off.
Right.
That's restructuring the policy in such a way that internally it's paying off that internal loan. And that's why you see the reduction in death benefit as well. But now you didn't have to come up with that outside capital to pay off that outstanding loan. Now you've extinguished it internally at a cost, but
yes,
what's the long-term gain of the benefit of that? And that's just fascinating to me that there's a vehicle out there like that you can, it seems like, oh, that's way too good to be true, and it's such an amazing vehicle that has so much flexibility.
Yes.
Like Ryan said, you can keep going if you want to. If you don't want to extinguish it and you want to keep that higher cash value compounding and so forth, and you don't want to RPU it, there's ways to do that, and you can keep it going, and and get that number even higher and higher if you want. And it's just, you have so many options.
Yeah, and that's a really good point, is that, as far as I know, and correct me if I'm wrong, Jason, life insurance is the only vehicle I've heard of that by definition contractually pays off its own debt. And that kind of makes sense, because if from a technical perspective, when we look at this cash value here, and I'll go back to here, just kind of show, when we see this cash surrender value, really that is just the portion of this death benefit that is currently available for your use.
Mm-hmm.
And in whole life policies, you'll see that over time, and are you seeing this here? This illustration, right? See how this number here, which is the cash surrender value in age 121, these are actuarially designed where at age 121, the cash surrender value equals the death benefit exactly. And the reason for that is that insurance companies didn't create these products so that savvy real estate investors can do what we're talking about. They just had to invest your premiums knowing there's a 100% certainty that if it's a whole life policy that's going to last up to age, unless you outlive age 121, they know there's 100% chance they're going to have to pay that entire death benefit. So they need to take that cash in your premiums and invest it at a certain compounding conservative rate of return, which they do internally with usually high grade bonds and stuff that's beyond the scope of this conversation. But they're doing that because they know that over time that death benefit is going to have to be paid out. So they need to take that cash value and invest it at a rate where it's going to equal that. So again, these things are all connected. You don't have to know all of that to take advantage. of this strategy, but it is a contractual guarantee. And that's a really powerful thing when you're dealing with high risk operations like real estate, private equity, and these large scale projects, right? And then you see that death benefit, before age 121 is still, significantly more than the cash value. So if we go back to that, and then I'm going to wrap this up and let Jason take it over. If you see, for example, and again, these are all netted out already. So this is the net death benefit. So the death benefit that would have been paid out if there were no loans on the policy. So let's say that there's a $20 million death benefit in year one, and unfortunately something bad happens to this GP. Well, he's got a $520,000 outstanding, or in this case, we have a $500,000 loan outstanding. That $500,000, if it wasn't paid back already, is just going to be subtracted from that death benefit, and the net amount is what goes to the beneficiaries, which in this case would be a combination of probably limited partners and the general partners. So I know that's a lot. I don't want to take any more time belaboring it, but hopefully you can see in a hopefully somewhat realistic scenario, even though it's hypothetical, how this could play in at the syndication level. Whereas, of course, if you want to attend our LP seminar, we're going to have in a couple of weeks, we can talk about how the LPs themselves can be doing the same thing, running their money through a policy. And, there's just literally infinite iterations to how this can all work. So I know that was a lot, but hopefully if you didn't get that, go back and replay it. It does take a while to wrap your head around this, but the more time you spend on doing this, I guarantee you that's going to pay huge dividends in the future.
Yeah. Yeah. And it's amazing. I love how, even when you start approaching retirement, so you've set this up, you're using it now for all these deals over the next 7 years and then beyond, because you've got such extensive cash value in other syndication deals or in your personal life, if you need to, and then by the time you get to retirement, like if you remember the earlier numbers Ryan was showing, you have year over year growth, cash value growth of 300,000 plus a year. And so now let's translate that to retirement, the retirement idea. Well, now we know you could, in let's say later retirement, let's say by age 70, you could technically supplement your retirement by 300,000 a year indefinitely, because that growth is more than 300K a year. And that's where, and then let's say you accumulate that 300,000 a year, 10 years, $3 million. And let's say you pass away with that $3 million outstanding loan, but your death benefit is so much larger. They're simply going to reduce any outstanding loan and interest from the death benefit and still pay the difference out to the beneficiary.
Which is also tax-free.
That's right. That's right.
And creditor protected if it's in a personal policy. It may not be the case in this example with the company-owned policy, but again, there's just so many different, that's why they call it the Swiss Army knife of financial products, right? There's just so many different ways it can, and by the way, what we haven't talked about this and we shouldn't belabor it, but a really important point is there's also accelerated living benefits built into here where you can get the death benefit accelerated above and beyond the cash value while you're still alive if you have a critical, chronic, or terminal illness that's diagnosed by a doctor. And that's actually something that I know in fact, somebody on our team has a very personal example of that, where it was an absolute lifesaver. And somebody didn't have to die in order to get the death benefit, even beyond the cash value. So there's just so many different things you can peel the onion on. That's where you'd think 2 hours would be more than enough. But if you go down these rabbit trails, you could spend hundreds of hours getting into this stuff.
Yep. Yeah. And I think, so many people, we teach this to so many people and half, if not more, really do. I hear it all the time, every week. Yeah. I need to start something like this one day. And they say, and I need to start something like this one day. And that's why I always go back to this. Yes. One day or day one, let's make this day one, let's get around to it. And let's make it happen. Let's make it happen. The second most common comment I hear is, gosh, I wish I would have known about this 20 years ago. Absolutely. I wish I would have known about this 10 years ago, 30 years ago, whatever. I wish I would have started this way back when, ... Well, yeah, I mean, when's the best time to plant a tree? Well, a long time ago, right? 20 years ago. When's the second best time to plant a tree? Today. today, not one day down the road. So I encourage you, if this speaks to you, and if you want to hear more, we're no pressure guys. We love teaching this stuff. Call us, reach out to us, and let's talk more through it and see what it's going to look like for you and your situation. Hey, if you want to get a copy of the Becoming Your Own Banker book, feel free to head on over to the website 1024wealth.com/shop. And you can actually grab the printed copy of the book and enter this discount, Unbridled, and you'll get a few dollars off, and we'll ship it to you. You can go to the infinitebanking.org website and order it directly from them. It's a little bit more as well. But either way, I'm not here to sell you books, but it is the principle behind why we do what we do. And so I encourage you to read that book either way. As we wrap up, please reach out to us. Let's talk. Let's see what makes sense for you and your situation. We fed you a ton of information in a very short amount of time, and I get it. And most people, myself included, when I first got into it, I had to hear this, 8-10 times before I really made sense. And it was just like, I got to keep learning. But it's so true. Once you get it, you know what to do.
And what I was just doing, which I think is really cool, is you can take, and I just tested this right now, you can take your phone, take a picture of that QR code, and that will go just like the previous one where you could buy the book through a discounted price through Jason's website. This will allow you to set up a meeting, or you've got our contact information right there. You can reach out to either one of us or both of us. However you want to do this. Jason and I are, a combo package here helping out. And then again, it's a completely separate but related skill set. I can bring the financial planning, and if you are looking for things, a lot of times especially in these bigger deals where you've got more complexity going on, whether you're an LP, a GP, passive investor, active business partner, whatever, if you need some time to wade into understanding the strategy and the planning first before you put, a ton of money into this, then I can help on that side of it. And then Jason, if and when you're ready, Jason and I together can help you structure these policies and actually execute on it. So hopefully we're covering pretty much the full gamut of everything you would need. And we've got, of course, our referral partners we work with as well. But, it's just, and hopefully you guys can tell that we are truly passionate about this. We love explaining it. We love learning it. We love helping people to implement it. And again, we're doing it ourselves. So our money is where our mouth is. But take that QR code or take that information and just reach out to us and let us know how we can help. We gave you a generic example here. Everything has to be very finely tuned and personalized to your situation, but we're happy to do that.
Yeah. And I think that's important to understand is like, there is no one size fits all approach. There just is not. And that's why, we can show you case study after case study after case study. But may or may not make sense to you. That's why I mentioned earlier, don't get hung up on the number of zeros. Right. Let's find out, let's talk, and let's learn what your situation is. What's your objective? What's your syndication doing? Does it even make sense for you in your syndication? Maybe it just makes sense for you in your personal life. Maybe it's not the syndication. Maybe it's just your personal life. And we have that conversation and just explore what works for you in your situation. We'll run some numbers and see what makes sense. You're not locked into anything. We don't, we don't charge for the education side of this. We don't charge for the strategy planning side of this infinite banking. We want you to be happy with something you can execute and move forward with confidence. We want to walk with you along the way. It is life insurance, which you are going to have for the rest of your life. I kid with clients. I say, hey, we got to get along because we're stuck with each other till one of our lives is up. So we need to get along. Let's get a team together and build something good for you and see what works. So reach out to us and let's see what will happen, guys. Thanks for having us, sticking with us through all of this information. And we'll look forward to chatting with you guys soon.